starting April 1, 2026, the new financial year, it actually brings tighter taxation norms and also stricter compliance regulations. First, on the market side, the government has increased the Securities Transaction Tax. If you see for the futures, the STT has more than doubled from 0.02% earlier to now 0.05%, while for options it has moved to 0.15%, making the derivative trading more expensive, specifically for the frequent traders. Moving now to the gold investments, there's an important shift in how the sovereign gold bonds will be taxed. The tax exemption will now be available only if the bonds are purchased from the primary market. If you're trading these bonds in the secondary market, any gains will now be taxable. Next, on the share buybacks, if you see, there's a structural change in the norms. Buyback proceeds will now be taxed as capital gains, but now in the hands of the investors. Earlier, the tax burden was on the companies, but now with the newer norms, the responsibility effectively shifts to the shareholders. And finally, there are some changes in the PAN rules under the income tax framework. So there's a mix of relaxation and also tighter tracking. For cash transaction, the PAN will now be required only if the total deposits or the withdrawals in a year exceeds more than 10 lakh rupees, replacing the earlier daily threshold. For the property deals, the limit has now been increased to 20 lakh rupees. For the vehicle purchases, the PAN is mandatory above rupees 5 lakh, and for cash payments at hotels, restaurants or events, the threshold has been now set as rupees 1 lakh. However, on the compliance side, the insurance sees stricter norms. PAN will now be mandatory at the very beginning of any insurance policy, irrespective of the premium amount. So these are the tax changes that will be effective and rolled out from April 1, 2026.